Have you ever gotten the feeling that the world of money has like a secret rule book just for the super wealthy? Well, it turns out it kind of does. And the wild part is, the strategies inside are often the exact opposite of everything we're taught about finance. So in this explainer, we're going to open up that playbook. Let's dive in.
Okay, so it all starts with a simple but honestly staggering number that you just need to see. You've probably heard of the 80-20 rule, right? But when we're talking about money, the reality is way more intense. It's the 90-10 rule.
As the source material points out, this isn't some abstract theory. It's a real-world observation you see pretty much everywhere. From actors to athletes to entrepreneurs, 10% of the people are taking home 90% of the cash. It's a wild imbalance. So that's the billion-dollar question, isn't it? What does this tiny 10% know that the other 90% don't? Here's a hint. It's not just about working harder. It's about a completely different way of thinking. And we're about to break down exactly what those differences are.
So we're going to tackle 5 core ideas that just flip conventional wisdom right on its head. We'll look at why the rich actually run towards debt, not away from it, how they embrace risk instead of just avoiding it, and the totally bizarre reason they get excited for market crashes. Oh, and stick around because that last point, it reveals the one single asset that makes all of this possible.
All right, first up, let's talk about a word that makes most people's skin crawl: debt. Right? We're taught to see it as this financial trap, something you got to eliminate at all costs. But for a sophisticated investor, debt is one of their most powerful tools.
I mean, just look at this. On one side, we're all told, get out of debt. But the investor's playbook says the complete opposite. Learn how to get into the right kind of debt. That is a huge, huge mental shift right there.
So what on earth is good debt? Well, think of it this way. It's borrowing money to buy something that actually pays you back. The debt is tied to an asset, like a business or a rental property that makes more money for you than the debt costs you. It's debt that goes to work for you. And this slide just lays it out perfectly. Bad debt, that's for things that lose value. Think about credit card debt for a vacation that's over, or a loan for a car that drops in value the second you drive it off the lot. It's a total financial drain. Good debt, though, that's for buying assets. That mortgage on a rental property is covered by the rent. That business loan helps you generate way more profit. One takes money out of your pocket, the other puts it in. See the difference?
Just let that sink in for a moment. The goal isn't just to be okay with good debt. It's to actively hunt for opportunities to use other people's money to buy assets that pay you. It is the ultimate form of leverage. Now, this next idea builds directly on that concept of debt, and it's all about risk. We're all taught to play it safe, right? Avoid risk no matter what. But for investors, that is probably the worst advice you could ever follow. They're playing a completely different game.
So on one side you have the mantra, play it safe. But the other side says, no, get better at taking risks. You see, the average person sees risk as a threat, something to run away from. An investor, though, they see risk as the price of admission for big returns. The goal isn't to avoid it, but to get so good at understanding and managing it that you can take on risks that scare everyone else away. That's where the real opportunity lives.
And here is a really brain-bending idea from the source. The more you chase absolute security, the more scarcity you actually create in your life. They are two sides of the same coin. By trying to eliminate every single possible risk, you also, by default, eliminate every meaningful opportunity for growth.
And this isn't about being reckless, not at all. It's a very deliberate process. Just look at the flow here. You start by building your skills. That knowledge then lets you analyze risk properly. Then you can take on calculated risks, which is what creates opportunity. And that opportunity is what leads to abundance. It's this powerful upward spiral. And it all starts with education, not avoidance.
All right, now for the idea that might sound the most insane at first. What's the one thing that terrifies almost every single person with money in the market? A crash. But for the investor who's prepared, a crash isn't a disaster, it's a Black Friday sale. I mean, just look at this contrast. The emotional response is completely, totally inverted. While most people are panicking, selling everything at a massive loss, the prepared investor is calm. They're ready. In fact, this is the very moment they have been waiting for. Here's the simple logic behind it. When the market crashes, fundamentally good, high-quality assets, we're talking great companies, valuable real estate, they suddenly go on sale for a massive discount. It is the only time you can buy premium stuff for bargain bin prices. And let's be really clear here. This isn't about luck. It's about preparation. The investors who win in a downturn are the ones who did their homework way beforehand. They have the skill to know what's genuinely great asset on sale versus what's just cheap junk. And, crucially, they have the cash ready to go while everyone else is running for the exits.
Okay, so we've covered debt, risk, and crashes. But all these seemingly contradictory ideas, they actually all come from one fundamental mindset shift. It's what the author calls seeing both sides of the coin.
When the average person looks at an investment opportunity, a new business, a rental property, a volatile stock, their brain is trained to see one thing first and foremost: the risk, the potential for loss, the downside. And that fear, it just paralyzes them.
But the rich investor has trained themselves to see the other side of that exact same coin. Yeah, they see the risk, they're not blind. But just as clearly, maybe even more clearly, they see the opportunity, the potential for gain, the upside.
This quote absolutely nails it. The fundamental difference that creates that 90-10 split, it's not access to secret deals or anything like that. It's a trained perspective. It's the ability to hold two opposing ideas, risk and opportunity, in your mind at the very same time and make a calculated decision instead of an emotional one that's just based on fear.
Okay, so this brings us to the final and honestly the most important piece of the entire puzzle. What's the one thing that makes all of this possible? How do you actually learn to use good debt, manage risk, see opportunity in crashes, and see both sides of the coin?
So we've walked through these huge mental shifts, right? From avoiding debt to using it, from fearing risk to managing it. But what's the one thing that powers this whole playbook? What's the engine that makes this entire transformation happen?
And here it is, the ultimate asset. It is not your house, it is not your stock portfolio. The single most powerful asset you will ever have is your financial education. It's the one thing that can't be taken from you in a market crash, the one thing that lets you see opportunities that other people miss, and the one thing that lets you build wealth from scratch over and over again.
And that really just leaves us with one final question. The playbook isn't a secret anymore. The concepts are out in the open. So the real question isn't what the rich know, but what are you going to do with that knowledge? How will you start investing in the one asset that truly matters?